Well, she spent over 25 years in financial services, from structured finance at Citibank and ICICI to the investment committee of one of India's most respected homegrown PE platforms. As managing director at Multiples Alternate Asset Management, Nithya Easwaran leads the firm's financial services and fintech investing practice and sits on the boards of companies as diverse as Arvind Fashions, Acco, Zerodha AMC, and just so many more. She joined Multiples at an inception stage and has helped build it into a $2 billion AUM platform that bets on entrepreneurs before markets do. A champion of women in finance and one of India's top 100 women in finance as well. Nithya Easwaran, welcome to the interview. Thank you so much for joining us today.
Thank you, Ayesha. Lovely to be speaking to you.
So, Nitya, you've been at Multiples since near inception pretty much. Tell me, what's the single biggest shift that you see in private equity now to what it was 15 years back?
If I were to summarize it in one sentence, I would say 15 years back, private equity, source of long-term capital.
Yeah.
Today, private equity, source of strategic leverage. Now, and let me explain that to you, right? The earlier journey was people saying, I'm creating a certain company, I need capital. Unfortunately, I have to share my pie with somebody. So it's moved from sharing the pie to saying, can I use this partnership to really expand the pie? Because Ps now are seen as, talent magnets. Getting talent into our mid-sized companies has become tougher and tougher. So having a private equity partner there helps a lot. PEs are seen as bringing the ability to consolidate the industry. There is a lot more operational knowledge which PEs are able to bring with getting the best advisors on the ground. So the whole language between founders, promoters, and private equity has changed. And I think we have been always advocating to founders to say, we diligence you, you please diligence us, because you need to. Don't go with the highest valuation, which is on offer. Valuation is important, of course, but that's not the be-all. And we can see that language changing. Now, promoters reach out to say, what have you done in your other portfolio companies? Can I speak to the founders there? And that's really, really encouraging, because that will set the trend to say, how do you differentiate? How do you be that? How do you get that aligned partner with you? So that's really what has happened.
Absolutely. And also, India has grown in the last 15 years. Why 15 years? In the last 5 years, with the spree of startups getting so successful now and being part of the listed pool itself, there's so many learnings.
Yeah.
Right?
And you see this whole ecosystem has developed, right? We have had from seed funding to venture to early growth to minority growth, private equity, to buyout, to late stage.
Who even knew these terminologies 5 years back?
Exactly. And that ecosystem developing has brought this sharp focus on what each stage kind of offers. And I think now is a really, really exciting time for private equity. I see the next decade to be one of where more and more Indian businesses will become institutionally owned. If you look at, the S&P 500, it's only 33% of the market cap is family-owned. If you see Nifty 500, that's 70%, right? So this is going to move. And that's where I see a lot more opportunity for private equity to take, more controlling positions in family-owned businesses. And I can see a lot more families seeking it. You can see that these are families who are struggling with the third generation, wanting to do different things. Probably not the business that their forefathers set up. They want to do more tech-based businesses, very different businesses. So there is a need for perpetuating the legacy. And now promoters see as saying, private equity is a good way to perpetuate the legacy. I can part sell and then sell some more, take it to control, and my company will continue. Even though, my own family may just be owners. So I think that's a very exciting phase we are in.
But is that coming at the cost of building businesses? Or the entrepreneurial zing is still very much intact in New India?
Yeah, entrepreneurial zing is very much there. So we have, two kinds of businesses in India, right? You have what we call the founders and
the generational businesses,
right? So you've had a lot of professionals come out and set up become founders and set up businesses. I mean, we've had some, if you see a business like Acco, right? What a kind of vision to set up a totally D2C digital insurance company in an age-old business of insurance. When we have had 25 insurance companies in India in the general insurance space, for Varun to come out and set that up and stick to that, to say data will make the difference. And that's entrepreneurial zing. Overall private equity owned, backed, but you have the entrepreneurial zing. Now coming to families, families need a kind of a balance between institutional ownership, having goal-driven businesses that you set up, metricized, and at the same time having this longer vision for the future. I'm reading your question as saying having institutional owners with too much of metrics playing and Excel sheets playing, does that really take away? And there's always the danger of that. I would be the first to acknowledge that if you're going to just look at your IRRs, your numbers on a business plan, you should not lose the zing, as you say. I was in a Harvard Business School recently, and they use a very nice term for this. They say, your companies have to be ambidextrous. And the term that's used is learning to exploit the current and explore the future. So really, we as private equity should also focus on saying, how can we practice this ambidexterity, where you're not killing the future for perpetuating the present. And I think that's there. The other thing that's kind of happened is, there's always this little criticism of saying, does private equity, do you only go for the exit, right? You build companies 4 or 5 years.
Perception is like that.
Perception is like that. But if you really look at it today, what are our sources of exit? We have, public markets, where public markets are dominated by now domestic institutions. With all this great mutual fund money, mutual fund SIEA happening, you have the larger mutual funds, and these are large, smart institutions asking tough questions of private equity-owned businesses going to market. Our other option is sell it to larger private equity funds. So the third is really strategic sale, right? All of these are smart buyers. So anything that we so-called make exit ready has to be future ready. I would say these are now synonyms. We cannot get away with just building for the short term, because and expecting a premium valuation to kind of come along the way. So I would say all of these are checks and balances as well, which will make private equity really built for the long-term sustainability of the businesses. And it's good to see, I think the other track record we urge people to see is, after we have exited the businesses, how have they done in the next round and the next round. And if that carries on, you've kind of built. And I think that track record is now building.
Yeah, and I guess the numbers say it, right? I mean, buyouts crossed, 51% of PE deal value in India itself last year. Does it seem like a cyclical blip, or does it seem like there is a structural reset which is currently at play?
It does seem structural, Ayesha. I mean, this 50% number, of course, you know how numbers are. You can cut it either way. Bain's report had this number to say 2024 was 43 billion, out of that 22 was kind of buyout. We look at the world ex real estate and infra. Even in that world, I would say out of 33 billion, 13 billion, those are big numbers, right? That's a large number of transactions that's kind of coming there. And if you further cut that, you would have the P2P, you would have the promoter selling to, what we call as succession-led promoters selling to private equity. And the third big is carve-outs, like our transaction in Zenex, which was carved out of the Zydus group and now owned by private equity and perpetuated further. Both of these, the carve-outs and the succession, put together is about 70% of this buyout, right? It's not just one asset moving to another, from PE to PE to another asset, right? We are not there. That's probably where some of the larger Western markets are, but we are not there. This is actual new businesses coming into institutional ownership. So it does seem very structural. Having said that, at multiples, we always believe that it's buyouts and there is enough of growth minority transactions also to do. The numbers are large there because unlike in Western markets, India is still growth. Even our buyouts are growth, is the underlying underwriting that we do, right? And some of the fear which was kind of, this whole PE as a shark fear, which was
Yeah.
there earlier,
Yes.
which you would have seen, has kind of gone away, because that is a very Western-driven imagery that has kind of come here, because in some of the lower growth markets, the primary role of PE was to go in, strip assets, reduce costs, leverage the company, leverage buyouts where a
Help
thing.
the promoter exit if need be.
Correct.
Yeah.
And take your money out and so on. That's a different narrative. India, the narrative is we can grow at 15 to 25%, depending on what the industry is, and how do we capacitize the company for that growth. So you will rarely see dividend stripping, asset stripping, over leveraging of companies happening here. So I think that's how that structural shift and narrative is. So I do believe it is structural, and it plays along with what I said earlier, increasing institutional ownership in Indian businesses.
Has there ever been, without of course naming the company, has there ever been someone who had all reds or most reds?
I hope we would have declined that deal then, in terms of, but this is, what we have done is our IC discussions now, which earlier would be a lot more of what is the macro, what is the business plan you can build, what is the IRR that you can get, what is the exit you can get, have become a lot more holistic to say, who are we investing with, and what is this, gap or match that we see in the talent. So we've had some, excellent journeys. I was, one of our recent investments is in a company called Shubham Housing Finance, where when we went in, we said this is a company with a lovely foundation. They've had high quality of business, but this requires a growth mindset. So here our recipe was to say, we don't need to change the founders. All we needed, what we saw in the founders was a lot of open-mindedness to say, tell us where we can get to and how we can get there. And we partnered them to say, let's bring in some really fresh talent. So we brought in a CEO, we brought in a CHRO, we let go of a few people respectfully and recrafted this whole journey. So those are some of the journeys that we will look to play in our future investments as well.
I want to talk about the generational businesses, because succession clearly now seems to be sort of explicitly driving within these large companies right now. What is it that you find most complex in such businesses?
Yeah. So I think this is like in many of these businesses, this is the life's work of the founder family, right?
Yeah.
I mean, it's a life's work. It's what they live daily. It's what they identify themselves with.
It's their identity.
What they speak about in their social circles, right? It's not easy to let go. So at the same time, they have this realization that I need to perpetuate this legacy. So what can we bring as a partnership here and what can we craft? In addition to this, some of the family members may be involved with the business as well. So how do you sensitively now craft this partnership to say, become owners and partners with us. Let's change the operating metric or philosophy of this company and let's take it together. Here, what we bring, I would say a little different from a lot of our peer group would be, we are not here to replace you. We are here to build around the core that you have built. People also, many of these businesses carry family names, right? As their, and the brands that they have built with time, their loyal people sitting in there. These are all the complexities. And how you manage them with that, with that sensitivity, at the same time build around it, is what we'll need to bring to make this successful, to help this transition. And we have also allowed a lot of these promoters to continue to own and take the value creation journey with us. I mean, that solves for 2-3 things. One, further value creation. So they don't feel they have sold it all and they've capped their upside, right? This is an upside journey they can take along with us. Also, they continue to be associated with the business and solves all their identity. They feel proud of being associated. For us, that continuity helps when we have to recraft the operating metric of the business. So that's kind of ideal. So rather than just saying, now we take it from here and we run with it,
and buy.
kind of buy and buy, but let's do it together would be how we solve all those complexities.
You sit on the boards of very diverse companies. What's that common sort of thread which ties that all? And I mean, I was going through all the lists and the names that you've mentioned, everything from Eco to Shubham Housing, very niche, licious, very niche, very different sort of businesses. But what's that one or other 5 set of things that a PE investor brings on the table for them?
Yeah. So if you see our own, and I'll answer it in terms of, we have now internally branded our value creation framework as in saying, we'll call it making it happen. Right? That's the,
nice.
It's like an action orientation with a lot of focus to it. So there are 2-3 pillars that it kind of rests on. One is talent, and that is probably the toughest conversation you'll also have, and the biggest value add. If you see in the last 18 months, we have brought in 5 CEOs across our portfolio, 10 plus CXOs into these companies. So talent is the biggest conversation at the boards of these, and we have to really look at, beyond the CXOs. You have to go CXOs -2 to really see where the gaps are. And to fill it, to say the future is different from what you've done in the past. And we, sitting a little away, are able to bring that lens of the future.
Because you're not emotionally involved.
And you're not too close, because the too close, you're kind of involved in your day-to-day, right? Talent is one. I would say second is consolidation. India is going through an unorganized to organized movement. If you see industry after industry,
every industry.
If you look at something as much as gold jewelry, what was
or licious,
prime example. The meat example, absolutely right.
Yeah.
All of these are getting organized now. When you're getting there, scale starts mattering. In again driving M&As into our portfolio companies and making them ready to absorb the M&A is equally important. We have had 15 M&As in our portfolio companies in the last 3+ years, right? So these are the common dialogues. Talent, consolidation, obviously everything around governance, right? But even something like ESG, which I think, you can treat it as tick the box, or you can treat it as, really like a value creator. And we are trying to, take that at that end to say this is real value creator, and don't treat it like a tick in the box. Or diversity, and bringing all these dialogues. We are also great believers, even in our privately owned companies, to bring quality independent directors into our companies, where we're not required to, but we do believe they add a lot more value, and they again are a nice bridge in the company to say, there is a founder view, there's a private equity view, and there is someone independent kind of sitting there, helping make this all work together. So those are some of the common things across all the boards that you would find. I think lately, what we are now pushing really hard for, even in the smaller companies, is to say, how do you link your annual operating plan to the KRAs across the board in the company? So it's not just, kind of leaving it to a lot of judgment, but saying there is a balanced scorecard, and you push the balanced scorecard and leave enough space for judgment there, for the softer aspects, for the long term, and not just the short term, but pull it out, say it, and make it transparent to your team, so that everybody is building towards that same tomorrow.